In my 64 years, I have learned one thing, and that is that you have an inner voice, and that inner voice tells you where to go and what to do. And a lot of people don't pay attention to that inner voice. And I'm going to tell you, please, please, please pay attention to that inner voice, because sometimes your instincts are spot on.
Welcome to the Going North podcast, where you will be informed, encouraged, and empowered to embrace your dreams and advance in life through authorship. I'm your host, best-selling author of the book Stay the Course, and certified leadership trainer, Dom Reitman. Be sure to check out the goods and services from every guest, as well as the host himself, yours truly. Now let the fun begin. Today's episode of the Going North podcast is sponsored by my good buddy Stanley McCluskey, author of the book Divorce is Worse Than Death. Be sure to check out the audio book, because yours truly is reading that audio book, baby. So definitely check it out. Add it to your collection, whether it's your reading collection or your listening collection, if you like to hear the host voice even more than you do already. Today's guest in particular, my goodness. Another reason why Stanley's or at least his wonderful book and audiobook project is a sponsor for this episode, because I got to thank him for hooking me up with this gentleman right here, who you're going to be hearing today, because he has one heck of a story and a whole lot of knowledge. And it was I was just thinking back to the pre-recording, my goodness. This guy right here, man, the good man, John Logan himself. He is a good dude, and he actually was the guy behind the idea of divorce insurance, which was an interesting idea when I first read about it in Stanley's book. And I was like, dude, this is freaking awesome. And then when I read a few more sentences down, I was like, oh, so they stopped divorce insurance a couple years after they put it out there, because that would have been one heck of a good product for folks that they need. And little did I know that I'd be interviewing that same guy who's the brains behind that wonderful idea. And the pre-recording was pretty interesting, because he lost a lot of his hearing over the years, and we had a lot of technical issues in the beginning. Before I could even press the record button, he had to log out of Zoom, then I had to log out of Zoom, and it was a whole bunch of nonsense, but we were able to get it stable enough to where he just started talking and going, and I was like, well, I guess I'm going to be saying the introduction later in a separate file, and we'll just capture as much as we can of his essence, and we'll go from there. And since he had a bit of a hearing issue, sometimes he wouldn't hear a lot of the stuff I was saying, so as per usual, I'm saying less than usual. So you're going to be hearing the voice of this gentleman right here, the legend himself, because this wonderful guy right here is a School of Hard Knocks entrepreneur, former portrait painter, nightclub owner, Spotlight Entertainment Magazine co-founder and creative director, Presidential Award-winning senior director of new product development for AT&T, or for what's now AT&T again, and founding the first company in the world to offer actual divorce insurance, the Safeguard Guaranty Corporation, and often seen as a status-quo-rule-breaking consumer advocate for in a financial planning space. So, my friends, you're about to hear the voice of the legend himself, John Logan. So give it up for him. Make sure you buy his books, The Millennial Money Tree, because it's a good book for folks of all ages, and you'll hear some stuff in that book and read some stuff in that book that'll definitely help you out. So check out the episode, and thanks for being a listener. And be sure to check out Stan's book too. Buy some copies of that too. Support the show, support the good people that have been on the show, and keep going north.
Have access to a 401k, and this got so much popularity over the years that it's now kind of the de facto method for people for saving for their retirement. And it was never, ever designed to do that, ever. The guy who created it, a guy by the name of Ted Benna, who was very kind enough to actually edit the chapter that I have in my book, about the 401ks, but he wasn't too fond of the title of the chapter because the title of the chapter is 401ks SUCK, and I have the K in parentheses. So, he was like, well, I don't think they suck, John, but yeah, I'll at least edit it for historic accuracy. And Ted created it as a tax saver for highly paid executives. That's the only reason it was created, to give companies a way to pay these guys more money without them having to pay more taxes. And then when, other big businesses found out that, oh, by the way, by doing that, you can get rid of your pension. And the pension is a big, big drain on resources for a company, as well as a pension. The employer has to make the decisions for where the investments go. And if they screw it up, class action suit heaven. But with a 401k, that risk is turned over to the employee. So if the employee screws it up, employers like, hey, hands up, you did it. I didn't have anything to do with that. You did it all. And that's one of the big problems with 401ks, is that most people do not spend a whole lot of time looking at what they're actually invested in their 401k. And there was actually a study done, I think it was by one of the big mutual fund companies, that showed that people spend more time looking for the options on a new car or what vacation they're going to take this year than they do looking at what their 401k investments are. And it was just a tremendous variance. It was like 4 hours being the car or the vacation, and like a half an hour being the 401k. And the 401k is what these people are depending on for their money for retirement. So if they get it wrong, it's kind of screwy, and nobody tells them that. Not to mention the fact that there's, the fees in a 401k were so embedded in there until the financial crisis in 2008 with the Dodd-Frank law that actually forced 401k planners to divulge all the fees that they were charging, because beforehand they didn't tell you anything, and they just took these fees out. I mean, on the average, somebody over 30 years in a 401k, the fees are going to be somewhere between $150,000 and $200,000. So if you don't know that money's coming out, you don't see it. But if I could find something to do with $200,000 at my retirement. How about you?
Sure. I can see a bunch of things. Shoot.
Yeah. So, there's those kinds of things that are behind the scenes that nobody really talks about, especially with brokerages, people that have individual stock accounts and those kinds of things. The people that they're working with, sometimes they're fiduciaries and sometimes they're not. And there's a way for somebody to even tell you they're a fiduciary without having to actually be a fiduciary. So, knowing who you're working with as a financial advisor is as important as the advice that they give you. So that's one of the things that I wanted to actually try to get through people's heads, is that not everything that you expect that these advisors are telling you is going to do, as well as they tell you it's going to do. But not to mention the fact that a lot of them get paid even when you lose money. So that's not fun. But my statement is, I've always said to people, hey, if you ask your financial advisor if they're going to give you back the money that they lost because they told you to invest in this, and then the next thing they tell you when you're losing money is, keep your money in the stock market, because when it rebounds, it's going to go back up. Well, that's great, but you lost so much on their advice to keep it in the stock market. On their advice, are they going to give that back? And I don't know anybody that works with a financial advisor that says, oh yeah, here, take all the money that you lost on me. So It'd be nice if that happened. It's not going to happen.
Yeah, it'd be nice indeed. So, on that note about a financial advisor, for those who feel like they need to look into getting a financial advisor, what do you think should be the main qualities they should look for in a financial advisor if it's their first time looking for one?
Well, there's, the thing is, you really need to have somebody who is working in your best interest. I mean, not just sometimes, but all the time. And now that they have a designation that is Registered Investment Advisor, or RIA, and RIA is required by law to be a fiduciary 100% of the time. But even that has its drawbacks, Tom, and the reason is because, for example, if you were just dead set that you wanted to invest in mutual funds, which I try to shy people away from too, because even Jack Bogle created ETFs because he didn't like his own mutual funds that he created. But the point being, if somebody was headlong that they wanted to invest in a mutual fund and told their financial advisor, I want you to find me the best mutual fund for my situation. If there was a mutual fund that had fewer expenses, in other words, it would cost the client less to be in, and it was on par with one that cost more to be in, but the one that cost more to be in had better potential in the long run, the financial advisor, if they are a true fiduciary, is going to have to point you to the one that has fewer fees. And it's because it is literally mathematically in your best interest not to pay, as much in fees unless there's a proven fact that it's going to, make more money, which nobody can foresee. So, that in itself is kind of a quandary, that part of the reason that the folks in the investment industry were pushing back so hard on the Department of Labor about these laws for fiduciaries that they finally kind of gave up on, which I was glad. But that's how the RRAs came about, and at least those folks, I would not want any of my friends to be talking to anybody who is not an IRA, only because, there are ways around being a fiduciary if you're even a chartered financial advisor. There are situations where, you don't have to act in the client's best interest with that designation. And so, those are the kinds of things that I bring to kind of the forefront in my book. And anybody who is thinking about investing in anything for any reason, whether it's just, as a sideline to their retirement fund, or maybe they just really like, the idea of, putting money aside and making money in the stock market and that kind of stuff, and it's money that they can afford to lose, it still makes a whole lot of sense to talk with somebody who, is an expert in whatever the kind of thing that you're wanting to invest in. And one of the things that I mentioned kind of briefly was there's a great book that I would recommend to anybody, besides my own, of course, that is by Tony Robbins, no less. It's a book called Money, Master the Game. And I think a lot of people will not read it only because it's like 600 pages long. But it is one of the most informational, educational, wise word kind of, here is the nuts and bolts of how everything works, and this is what you need to know kind of book. And on top of that, at the end, it's actually about a third of the book, he's got interviews that he did personally with guys like Paul Tudor Jones and Ray Dalio and all these like super smart, wealthy investors that were very open with him and telling him, what they would invest in if, they were just starting out. And one of the interviews is with Jack Bogle before he dies. And Jack was telling Tony about, why he created exchange traded funds. And the reason was because he realized that mutual funds fees were eating into people's investment gains at such a degree that he wanted to kind of change the industry and created this thing that was new at the time, the exchange traded fund. That was based on the index. And when you understand kind of some interesting things that nobody really pays attention to, except for nerds like me, then it makes a whole lot more sense, because there is an organization called, the acronym is SPIVA. And what SPIVA stands for is S&P index, in other words, the S&P 500 index, market index, versus active, versus active, and they don't have the M on there, but it's active money managers. So in terms of what an active money manager is, that means somebody who manages a mutual fund. So what this organization does is every quarter, they look at the results of every single mutual fund that's out there, everywhere. And then they compare it against what the S&P 500 index has done and see who's done better. And believe it or not, Dom, over a longer period of time, admit the mutual fund money managers might do better a year, 2 years, maybe even 5 years sometimes. But over 15 years or longer, which is, of course, most people are saving money for a lot of years, 94% of mutual fund money managers do not even meet, let alone exceed, the S&P 500 index on an average basis. That's crazy. These guys are getting paid big bucks from their clients in the mutual fund to make sure that they do better than the market. And over time, they suck. They just, pardon my French, but they suck. And, when you know things like that, you're like, okay, wait a minute. And it was funny because in the interview with Bogle, he was talking about that. And Tony Robbins just point blank asked him, he says, well, Jack, there's 92 million people in the United States that have invested in mutual funds. He said, why is everybody investing in mutual funds? And Jack Bogle's response was one word. That one word was marketing. And I was like, what? And what he said was that people believe the hype. And it's true. People read the prospectus and they read what the market managers want them to read. And they talk about, this year or that year that they did really well. But the reality is mutual funds come and go like the wind. They're like, crops. They're good one year and they're bad the next year. But, what these big organizations like Fidelity and Schwab and all these dudes, they just move people from fund to fund to fund, and they promote the ones that are doing well. They never promote the ones that they basically dissolve. And a lot of people are in some of these funds without even looking at what they're doing, just thinking that, well, somebody told me that this was a good fund to get into. And then, then they scratch their head when they look at their statement, and their statement is like going south instead of going north. So, that's one of the interesting pieces of that. I said, does it make sense?
Oh, yeah, it makes sense indeed. And it's so true about the whole marketing pieces. Like sometimes people don't want you to know about certain things and they don't market it or tell people, or like usually keep it under wraps and just keep it hidden from people.
Yeah, I mean, that's part of the reason I wrote the book the way I did. I'm doing a kind of a expose on the industry and exposing a lot of things that nobody will tell you about, but you certainly need to know about if you want to, save money. And one of the things that and it's part of the reason that I'm such an evangelist for index life insurance is index universal life is because you can gain in an index universal life policy, we call them IULs for short. You can gain, for example, you would invest in a fund, and most times it's like the S&P 500 index, right? The same one that SPIVA uses against everybody else. You're tracking what that index does, and in a lot of years, you will get all of the gains. In most years, you'll get all the gains. Some years, you'll only get part of the gains because there was a cap on these things. But the best part of it is when the S&P goes south and everybody else is losing money in 401ks. I mean, if you're like 2008, people lost their shirts. People lost their entire life savings. Not a single person that had an IUL lost a dime. They do not lose money. They only gain money, or they flatline. If it's a negative year, you get a zero interest raise. Is basically what they call it, a floor. And so the least amount you could get is zero. And that's only when the market goes south. But comparatively, look at history. I mean, how many times do we have negative markets? There's not a lot of them. I mean, there's not even a third over the last 100 years have been negative. So in most years, you're gaining something. In the years that it loses, instead of losing your shirt, you lose nothing. And on top of that, you got a lifetime insurance policy that you're paying into. And all it does is increase the value year after year after year. And if somebody structures an IUL the right way, because there are wrong ways to do it, and that's where a lot of the critics come and talk about, well, the agent is the only one that makes a lot of money. No, not really. But there are ways to set it up so the agent makes a lot less money and you make a lot more money. And smart people with good agents will set it up that way. And if you do that, then it's got a 23-year track record. So we can look at it and say, okay, what has IULs done in the last 20 plus years compared against a 401k? And just to give you an idea, it's between 200 and 400% better than a 401k with the same amount of money invested. So to me, that would make me want to look at one. I don't know about you, but
maybe even with all five eyes, maybe, right? Have to look at one, right?
Yeah, and the thing of it is, I mean, you could set these things up for your grandkids as soon as they're born. And you could buy them literally a lifetime insurance policy that they will never have to qualify for. By the time they reach adulthood, they'll have just a bankroll that they could use for college, or they could use for, a down payment or a house, and give them a leg up that you and I, and in fact, even my kids, is never going to see. So it's because these things weren't around 25 years ago. They weren't invented until 1997. So, we couldn't do that then. I didn't even find out about that. I was in the insurance industry for almost 7 years before I even heard of these things. The insurance industry never advertises it because it's like this kind of, side bet that they have going on that you're never, ever going to see a television advertisement for an IUL. I can pretty much guarantee that. But have you ever heard of them? Have you ever heard of an index universal life policy?
Nope, actually I haven't.
See, that's what I mean. But they've been around for 20 plus years, and the people that have them are not complaining.
Oh my goodness. It's something else that folks haven't even heard of yet in the wonderful world of today is the fact that your creative mind led to something called divorce insurance.
Yes. Yeah, that was a product that came about because of my own really nasty divorce. And that was actually something that I had kind of an epiphany when, my ex-wife literally came to my house while I was at work and took everything out of my house. Everything. I'm not kidding, Dom. I mean, everything. The only thing is she left was light bulbs. And so, it was one of those deals where I said to myself, why isn't there insurance for something like this? And me being the longtime multiple entrepreneur that I was like, this is kind of an opportunity waiting to happen, because there certainly were more people like me than met the eye, so to speak. And a little bit of research proved that 44% of women in the U.S. go below the poverty line after divorce, and men aren't really far behind in terms of what happens to people after divorce. Unfortunately, women get the short end of the stick a lot because they're custodial parents for the most part. So that means if they're going into poverty, their kids are going into poverty, and men, and a lot of times they never ever recover. About 25% of them never get out of poverty after that. So we were looking at a way to not just protect people from the untold liability that nobody can predict when you get divorced, but also, to keep families out of poverty. And, when it came down to it, I would tell people, look, if I can keep even one kid out of a life of poverty by offering these things, I know I'm doing the right thing. So don't ever tell me I'm not. And that really was, kind of what set us off to do this. And the whole idea was that you would buy it very much like you would buy a term life policy, in that you could buy as much or as little as you needed. And you would pay a monthly premium, and it started at just $15 a month. And it was based on, how much you wanted for what we call the successful marriage benefit after 25 years. And that ranged from anywhere from $10,000 to $3 million. And of course, the premium went up the higher that, the amount of money that you wanted. So what would happen is, over the time, if you got divorced during that 25 years, then we would pay you based on how long you had been in the program. And it was always far more than what you had paid in. It was a sliding scale, and it was always 30% or more higher than what you paid in premium. So from an investment standpoint, certainly you're not losing money, but it wasn't something that was going to make people rich. Because, it wasn't designed to do that. It was just designed to, offset, a lot of the expenses they would have normally. But the reality was, if they stayed married for 25 years, then they got a huge windfall. They got more than 200% of what they had invested. So from a standpoint of, and if you want to call it an investment, which it's not, it would have been insurance just like an IUL is. But the point is, putting money into something and getting a lot more back makes a whole lot of sense, especially considering we wanted to kind of financially incent people by actually paying them more money to stay married. We were trying to convince them, hey, maybe it's smarter for you to work through your problems. And here's this big carrot on a stick with a lot of dollar bills attached to it in order for you to do that. And that would work, of course, naturally in our favor, too, because if we didn't have to pay out a divorce claim, we could invest that money and make sure that the people that had the successful marriage benefits had way more than, what they were expecting. So that was the whole idea behind it.
And one heck of a great one, too. I was so amazed when I first read about it in Stan's book when he mentioned that. I'm like, wow, this is freaking genius. And then a couple sentences later, it's like, oh, yeah, so the powers that be silenced it. So this doesn't exist anymore. Like, oh, well, that was fast.
Yeah, it was, for all the people that got involved with us, it was it was either one of these things where they said, well, that's just a crazy idea, you're nuts, or they were absolutely like an apostle and I was Jesus. I hate to use that kind of phrasing, but it was, that's the way it worked. People were like, holy cow, this is genius. We need to do this. And come hell or high water, the team that I had was trying to do it until they figured out a way to kind of roadblock us, and that's really what it came down to. But the laws that they changed had to do with something that first was one that made any life insurance policy, because let me kind of qualify that. We created originally wedlock divorce insurance was a liability policy. It was only for divorce. And the product that we had out in the market in 2010 and 11, the insurance underwriter for that really just pulled the rug out from underneath us and screwed us. So we chopped that and said, look, that was an okay product, but what we want to do is actually promote marriage and not just promote, keeping yourself out of bankruptcy and divorce. So we added this marriage benefit on, and we changed it into a life policy, which did two things. First, number one is it's a win-win-win, because if you die, you get the life benefit. If you get divorced, you get the divorce benefit. If you stay married and you're still alive, you get the marriage benefit. So there's no way that anybody could ever lose money on this policy unless they just flat out stop paying premium for no apparent reason. And, chances are if somebody's going to do that, they're planning on divorce to begin with. So why would they do that? But anyway, the whole thing was they changed the laws of how you needed to collect money, and they tried to push us into being like a whole life policy. And if you have a whole life policy and you get divorced, that has a cash value. So, an angry ex-spouse could have her lawyers attach that life policy and say, that has value, you need to sell it and give us half. So what we did was we created a policy that didn't have any cash value until a file was claimed. In other words, it was like an auto insurance policy until 25 years from the date it was issued. Then it automatically had this value, and it was paid out immediately. And so what they did was they changed the laws so that any life insurance policy over 20 years had to have cash value the entire time. Well, that would naturally just axe our divorce benefit. So we said, all right, well, if they're going to do that, then we'll just make it 20 years and, it'll eat some of the profits, but it's still doable. And they saw us coming. They were like, oh, no, yeah, we got you on that one too. Because then what they did was they made every policy that has endowment benefits, which is what the marriage benefit, the successful marriage benefit is in the insurance parlance. It's an endowment. Any policy that is any length of time that has endowment benefits has to have a cash value the entire time. So that combining those two things just put us out of business.
It's such a shame too. It's like, oh my goodness, like, dude, like what brain steroids does this man get his hands on to come up with this great idea? And it's like, oh man, we got to find him steroids and get rid of this idea instantly because he's tearing into what we have built. So with having that idea dashed, how were you able to bounce back from that?
It was tough. I'm not embarrassed to say that it ended my second marriage as a result, because I joke with my friends, my second wife bet on the wrong horse, I guess. Because, when I first met her, we were doing very well. We had just launched Wedlock and raised a lot of money to get marriage insurance off the ground. So, her and I and everybody else thought, this was going to be a successful business, and, things were going great. And then they weren't. So, that caused a lot of marital strife. And so, it took its toll, and I got divorced a second time, but, at least that one wasn't quite as ugly as the first one. So I made sure of that. I did not have divorce insurance though, because I couldn't get it for myself. But anyway, yeah, it's like I said, it was really tough, because then I, right about the same time, I went deaf, and it was really tough for me to kind of work through the turmoil of losing a business. And to be honest with you, Dom, that's the first failure that I've ever had. I've had numerous different ventures. All of them, I've been very lucky, I think, in that they've all been wildly successful until that one. And so for me, that was kind of a wake-up call to, say, hey, look, maybe it's time to just kind of like slow down, figure out a way to add value to other people's lives, and not worry so much about getting rich. And so that's pretty much what I did. I'm happy with where I'm at now, and the book's doing really well, which I'm thankful for. And I've got a lot of other stuff kind of in the works. Believe it or not, though, we are still talking to people about launching a divorce insurance business somewhere outside the U.S. I will not own more than 5%. I'm just doing advice for people who want to do it somewhere else. We've got an organization in England that has been talking with us about doing it for the last 9 months or so, but they're kind of stalled right now because of Brexit. We have Egypt, which last year drafted a law to make divorce insurance actually mandatory when somebody gets married, because there were so many women that are going into poverty in Egypt after they get divorced, because their divorce rates have just skyrocketed in the last 10 years. So they are still bouncing around the legality of forcing people to buy a divorce insurance policy when they get married. And from what I've gathered from folks that are in the know down there, it's going to take 4 or 5 years before they even make a decision on that. But, that's fine with me. But, it's still interesting to see that there's so much interest in this. And part of the reason, even after the U.S. laws kind of nixed us, why we spent probably another 4 years trying to get this thing off the ground outside the U.S. before I had that come to Jesus meeting with the AG here. And part of it was because over the time that we started launching this thing, I got so much interest from outside the U.S. It was crazy. We even had a whole organization in Zurich that was basically a mirror company of Safeguard Guarantee here in the U.S. that was raising money in Europe. And that kind of went south when I, took myself out of the ball game. But there's still, lots and lots of interest. We had people in South Africa, people in Poland. I did an interview in Brazil, which was really odd. I was on one of their morning shows, and they sent me a tape of it, and they had dubbed my voice into Portuguese. And I had this really masculine voice on the show. And I was like, well, I wish I had that voice. So it's kind of funny watching that. But Australia had a big interest, Malaysia, Japan. Lots of different countries had. We had a big organization in France and like I said, the UK and Germany. I wish, that somebody would get this off the ground before I kick the bucket. But I plan to live to be 150, so, that's going to be a while.
Woohoo! That's what I'm talking about right there. That's what I'm talking about indeed. Yeah, because if all those countries have interest, it's only a matter of time before one of them is able to really like the match and throw it in the pile of gasoline on this.
Yeah, I would love to see that happen. And I've tried to encourage people to start a lobby to get, the insurance industry here to reconsider, because, there are ways to do it that wouldn't interfere with life insurance. For example, you could create a whole separate category like they did with pet insurance. I mean, who would have thought to insure the health of pets? They don't insure under just normal health insurance for humans. They've created this whole separate insurance category called pet insurance. There's a whole separate category for legal insurance. So why wouldn't there be a whole separate category for marriage insurance? But I think what they're worried about is that it was going to encroach on the profits of term life, because all of us in the industry know that only about 2% of term life policies ever claim, and the ones that do are normally from like accidental deaths, not from natural causes or illness, because most people outlive their term life insurance, or they just flat out lapse because they had it with a job and then they changed jobs, so that life insurance policy they had with their old job lapsed. So all that is free money. The insurance company never pays out a dime on most term life insurance policies. So when a company like ours says, hey, look, we're going to offer something that competes with term life, and oh, by the way, you get paid regardless, one way or the other, which term life you don't, of course, then yeah, I could see the backroom deals that were going on with that. Because I had a mole in the NAIC, the National Association of Insurance Commissioners, so was calling me every quarter saying, "You are the topic of conversation again." I'm like, all right, now what? So it was never pleasant when I got those phone calls. But hey, this is one of those things where I look at now, and to me, this is right now, the 20s, to me, when I look back in time and say, what could I compare this era to? I literally compare it to the Roaring 20s. And the reason I say that is because my father was born in 1919. And when I look at what transpired in his lifetime, but the 20s was a transitional period from this kind of, horse and carriage kind of stuff to automobiles. Radio was invented. The airplane was invented. All this happened during that 10-year period for the most part, or right before then, but was really kind of, growing during that 10-year period. And there was such an exuberance of, wealth accumulation. People talk about the wealth disparity of the rich and the poor now. Look at it in the 1920s. There were gazillionaires compared to what the average Joe lived their lifestyle on. And so, that is very similar too. And now we've got the internet has now become a part of everybody's life. It's woven into everybody's lifestyle now. People walk around with a computer in their hand that has more computing power than the Apollo space mission ever did. I mean, your car has more computing power than that, but this is basically a handheld computer you're walking around with that can tell you anything in the world that you ever want to know. And on top of that, we've got this whole transition of currency from cash and coin to the potential of digital currency with Bitcoin and that kind of stuff. And if you don't already know, the IMF in Europe is really talking about seriously switching over from cash and coin to completely digital currency, meaning the fiat currency that you carry around in your wallet isn't going to be worth anything. You're going to have to do either Bitcoin or their own national digital currency, which is kind of where they're aiming at. And I don't blame them. I mean, it makes all the transactions foolproof. They're trackable. You could get rid of a third of the employees of probably more than a third, probably more than half, probably 3/4 of the employees of the banking industry, because it's all going to be electronics and there's nobody going to have to be processing coins and bundling, currency and that kind of stuff. So, all that administration and processing stuff goes away. And we've started to see I guess you want to call it the embracement of Bitcoin and Ethereum and the more popular kinds of digital currency. Of course, this goofy thing with Doge that happened with the GameStop folks, but that was kind of a joke, and I don't think it went from like 2 cents to 8 cents real quick. So if you had $10,000 in there, all of a sudden you had like $100,000 real quick. But the thing is, I think in the next 10 years, this 20s, there's going to be that same kind of transitional period that happened in the Roaring 20s. And a lot of people that I talk to are have the same kind of mindset. So it's going to be really interesting to see 10 years from now where we're at. And I kind of feel like me back when I was raising money, saying nobody's going to need to talk to an insurance agent, and you're going to be on the computer 24/7. Now I'm telling people everybody's going to use digital currency, and by the way, in 10 years from now, I'll be able to walk into Walgreens and probably buy myself a new organ, because all of, the stem cells and medical just miracles, if you want to call them that, coming along really fast. So I'm looking forward to it. Like I said, I'm going to live to be 150. I wasn't kidding.
That's right, folks. He ain't kidding. He's adulting.
So what else can I tell you, Dom? That's my story. I'm sticking to it.
There you go, sticking to it like glue, honey, and heck, even more glue indeed. So my goodness, so with all of this wonderful creativity that you have, like any advice for those out there who may want to embrace the creative side, since you've created so many different products and lived multiple lives in this one life?
In my 64 years, I have learned one thing, and that is that you have an inner voice, and that inner voice tells you where to go and what to do. And a lot of people don't pay attention to that inner voice. And I'm going to tell you, please, please, please pay attention to that inner voice, because sometimes your instincts are spot on. And, the idea of people wanting to, I guess, live a life of the American dream, I think that's changed to a big degree. I think now the new American dream is financial independence. People want to be able to, the way I define financial independence is being able to do what I want, when I want, with whom I want, for however long I want. And, people who have a day job, 9 to 5, whatever, can't do that. Somebody else controls their life. And if you're financially independent, you're the one that controls your life. And that's, I think, the real dream now that most people have, is to be in control of their own life. And so there are certainly ways to get to that faster that are available to people online now. There's whole communities of people that talk about that. The acronym is FIRE, Financial Independence, Retire Early, and that kind of stuff. But live your dream. Don't put off doing that until you're old and gray. Do it now. That's what I did my entire life. If I got bored, I said, screw this, I'm going to do something else. And thankfully, I was lucky that the stuff that I wanted to do made me some money. but sometimes that doesn't work. Failure is a good teacher, but you learn from it. So.
Amen to that. Amen to that. Well, coming down to the magical question for every guest, and that is, if you were to wake up tomorrow and you were 25 again, but this time in 2021, with all of your amassed knowledge and wisdom, what advice would you give to yourself?
Oh, gosh. I'm 25 now in 2021 again?
Yeah, with all of your amassed knowledge, man.
What would be jeez. I think I would give myself the same speech that I just gave you. It's like, listen to that inner voice and pay attention and buy Bitcoin.
There you go. Oh man. Well, that's what I'm talking about indeed. That's what I'm talking about indeed. So for those who also not only want to pick up the Money Tree book and keep up with what you're doing, what's the best way for folks to reach out to you, John?
My email is the easiest way. It's john.logan@moneytree.ventures. Very strange domain name, but that's what it is. Moneytree.ventures. John.logan@moneytree.ventures. Feel free to email me. I'm happy to give advice to anybody for free.
Well, there you have it, folks. Grab John's book. Let that one book be the seed to your giant money tree. Heck, probably your money forest, even. That's what I'm talking about, indeed. That's what I'm talking about, indeed. So, any closing thoughts before we stop the recording, my friend?
I appreciate the opportunity, Tom. I look forward to, hearing some more of this podcast because it was new to me, and now I'm catching all of it.
How's it going, you super special, awesome human? Since you made it to the end of this episode, it looks like you really enjoyed yourself. Since you enjoyed this episode, be sure to share it with at least 3 people in your network and tell them what you really liked about this episode. Heck, even shoot myself or the guests an email and let them know what you liked most about this interview so that way they can stay inspired to keep pushing out great work.